Hi, Mark Lund here, author of The Effective Investor, and today I want to talk about the randomness of returns. This first slide I want to show you features annual performances of major asset classes in the U.S., international, and emerging markets over a 15-year period. The top chart ranks the annual returns from highest to lowest. Using the colors that correspond to the asset classes, the bottom chart displays annual performance by asset class. In both U.S. and non-U.S. markets, there's little predictability in asset class performance from one year to the next. Studying the annual data in the slide reveals no obvious pattern in returns that can be exploited for excess profits, strengthening the case for broad diversification across many asset classes. Investors need portfolios that reflect their different financial goals, time horizon, and risk preferences. Take a look at the next slide. Although there is no perfect portfolio, many investors will find that a sensible approach incorporates diversification across multiple sources of risk and return. This slide illustrates how various model portfolios along the risk-return spectrum might be constructed to capture the equity size and value risk premiums in global markets. To simplify the illustration, the relative proportion invested in equities remains fixed. The changes across the model portfolios involve diversifying the allocation across a greater number of equity asset classes. The exhibit clarifies the diversification benefits of investing across multiple asset classes within the equity portion of a balanced portfolio. Now, here in this last slide, you can see that the upper chart ranks the year-to-year returns from highest to lowest of the model portfolios using the corresponding colors. The lower chart features historical annual performance of the model portfolios over a 15-year period, with the far right column showing annualized returns and standard deviations for the entire period. The dispersion of colors now appears mostly uniform and consistent with the more diversified model portfolios prevailing in the majority of one-year time periods. This example illustrates how markets tend to reward investors for the risks they bear, with riskier strategies generally offering higher expected returns. Asset class returns vary considerably from year to year, and past returns offer little insight into future performance. However, combining multiple asset classes tends to minimize the volatility associated with this random behavior. Global diversification reduces the effect of a single asset class or market. The historical returns chart offers compelling evidence that structured portfolios are a reliable way to capture the returns associated with multiple measures of risk across the global capital markets. If you have any questions about how well diversified your portfolio may be, feel free to call me anytime. Well, that's it for today. Have a great day.